and that is the stocks on the editor's radar. We'll be flagging off Tata Motors DVR as well as what's going on within the entire consumption space. Let's begin, Nikunj, by just drawing a parallel between the performance of Tata Motors versus Tata Motors DVR, and what are the observations?
It's always been observed that DVR is trading cheap, and it is trading cheap. And as individual investors, since you do not really care about the voting rights, DVR is always the best instrument to buy into. This year also, optically, the Tata Motor stock has done very well, and you tend to think that, okay, DVR is not doing that well. But just think about it. YTD return for Tata Motor DVR and for Tata Motor is actually neck to neck. Similarly, in last 1 year, the gap which actually was there between the Tata Motor DVR and Tata Motor actually has narrowed down. Well, the reason why I'm bringing it up is because Tata Motor DVR and Tata Motor stock, they both actually right now are the go-to stocks. The normal tendency is that you tend to think that DVR gives you a better entry point, largely because it's trading at a discount and it has underperformed. Well, that's not the story. On a 5-year basis, there is underperformance, but in last 1 year, the discount actually has covered up. I, for one, think that while the DVR optically is a low denomination stock, but from an institutional investor standpoint, because Tata Motor stock is dominated by institutional investors, not retail and HNI investors, I think one is better off buying Tata Motors.
Okay.
It is better. Why? Because that's where the institutional interest normal would be there. Institutional investors do not want to buy DVR because they've got compliance and other things which really kick in. So my limited point here is that this is how the Tata Motor DVR in last 52 weeks has moved. DVR has done much better than Tata Motors. And if you still want to buy Tata Motors, it's better to buy Tata Motors, the stock, rather than the DVR.
Okay, that's Tata Motors versus Tata Motors DVR, the preferred option. Let's move right on and talk about FMCG, because the annual reports have trickled in, and clearly the word that seems to be highlighted is that there is a slowdown and it is volatile and it'll take time for things to recover.
Well, whether it's HUL and Tata Consumer, the annual reports, what we've looked at, they are pretty much admitting the obvious, that the rural economy had hit their business last year, and they do not expect a very meaningful recovery, at least in the first half of this year. That clearly means that urban FMCG companies will have a niche advantage. Companies which are moving really the premiumization basket, they will have an advantage. And companies which are focusing on new verticals and are adding new product to their pipeline, which is focusing on urban consumption or semi-rural, I think that will have an advantage. Most of the companies are also of the view that there is margin recovery for the international business, and there is going to be strategic initiatives they would be taking. So I think the key takeaway, frankly, which is coming from a Tata Motor annual report and the HUL report, is that consumer business will recover, but it will be urban focus. Worst of the margin, I think that compression is behind them, and new product category launches are going to be the driving factor going forward.
Okay, there you have it. That's the outlook coming in, Aisha, on Tata Consumer as well as HUL and the Tata Motors DVR.